Welcome everyone to our first market update webinar. The aim of these videos is to give you a current and up-to-date view of what is happening in the world and the impact, good or bad, this is having on your portfolios. So today we're joined with Phoebe Stone, who is Head of Sustainable Investments with LGT Wealth, who are one of our partners. Welcome, Phoebe. Thanks for joining us today.
It's a pleasure. Thank you for having me.
Brilliant. Right. Okay. So we're going to dive straight in to the questions that we've got here. So question number one for you. After the 2008 credit crisis, we saw 12 years of almost solid growth year on year. In the last 2.5 years, though, we've seen two significant drops in the market, COVID being the main driver behind the first one, but we did see a good recovery off the back of that and sustained performance throughout 2021. What are the reasons behind the most recent drop since January this year?
Yeah, and I'm really glad that you gave that context in terms of where we have come from over the last decade and beyond, because we are in quite a different market environment now than we have been for many, many years. I think looking back, it seems like it was easy to invest post 2008-9. What it felt like from an investment professional's perspective, obviously, is very different. It never feels easy. But certainly the idea of a very supportive monetary environment. And what I mean by that is central banks providing liquidity to the system in the form of quantitative easing in order to ensure that very sort of stable set of financial conditions for companies, and I guess more importantly for the policymakers, individuals, and therefore countries. That environment has changed quite a lot since the start of the year, and that's been triggered really by inflationary figures, which have been stubbornly high since the start of the year. There was certainly the expectation that inflation would start to drop off. That didn't happen in January and didn't happen in February. And then we had the compounded effect of the war in Ukraine, which has meant that inflation, if it was going to manage to be taken under control, certainly has more challenges ahead of it. So the markets have been much more volatile this year than what we've been used to. As you say, there hasn't been the rebound that we saw very quickly after the COVID falls in markets. And the reason for that is that the future over the next couple of months, when we're thinking about inflation, still does look uncertain. The war in Ukraine is still going on, and that is impacting energy prices as we try to reduce our reliance on Russian oil and gas, and food prices, two major components of inflation. However, there are reasons to be a bit more positive about the inflationary picture. Things that to look for are the costs of shipping. So many of the goods and services goods that we consume on a daily basis obviously are very heavily involved in being shipped around the world and their supply chains. The cost of shipping has fallen by half of what it was at the peak during COVID. So from 20,000 for a container down to 10,000. That's a really important leading indicator. And also we've seen the starting of the softening of China's zero COVID policy. Just a couple of months ago, 83 out of 100 China's most economically important areas were all in lockdown all at the same time. That's millions and millions of people, hundreds and thousands of factories and areas and cities. And so having China move into their next stage of dealing with COVID and managing to open up will have a very positive effect, we believe, in the coming months on the inflationary picture.
Fantastic. Thank you very much. So the way I've seen it and the way I've been explaining this to clients over the last 6 months is that we had, obviously, COVID was a big shock to the system. We pretty much didn't know where it was going to end until we started to see the vaccination program rolling out. The government has effectively underwritten the UK economy for the best part of 18 months. And that was done probably with the real reason that they felt that this wasn't, it shouldn't push us into a recession through COVID, but it was about actually just limping through that time, but allowing us then to push forward as soon as we were able to actually get back to some sort of normal. Effectively, they turbocharged the economy last year, which is why I think we saw such a dramatic growth and return over that 12-month period. But equally, that comes with its own problems, that has actually started to push the inflation that we started to see towards the end of last year, mainly because there was such pent-up demand for goods. You've just alluded to the fact that China's been closing sporadically throughout the last 2 years. And with shipping container prices and the fact that, quite frankly, we've relied upon a global distribution chain that has been working extremely smoothly for decades, And all of a sudden, we've had a series of events here that have basically put that into a bit of a bit of out of control, really. And I guess all of those things has created a bit of a perfect storm in some respects that has meant that we had domestic inflation, which was probably driven by lack of employees out in the market, the lack of labor to, for example, drive the HGV lorries around to deliver the food, to then actually have people to pick the fruit during the summer months. And I guess that's all had a domestic inflationary pressure combined then with the effect of some of Brexit coming through. We've seen the pound devalue, which has obviously then meant that anything we're importing costs us more. And so we're in this position where we've not only had domestic inflation, which I think you felt was going to dissipate from the beginning of this year, and assuming we hadn't had huge amounts of imported inflation, we wouldn't have had too much of an issue. But we've obviously started to see that. And then, as you said, it's been compounded by the Russian-Ukraine war. So is that a fair assessment of what's happened over the last 18 months?
Yeah, absolutely. I mean, I think you captured it pretty well there.
Great. Okay. So I guess the next question is we've seen another significant drop in the last 2-3 weeks. Can you just explain why that's happened, why it was such a sharp shock, and I guess a bit about whether you think that's going to continue or whether there's an element of pricing in of various aspects?
Yeah, and I'll try not to get too technical on this because there have been some fairly individual catalysts to the very recent market volatility, which has caused a lot of different assets, so not just equities or risk assets, but also fixed income assets to fall and be very volatile. So this all can be traced back to the same real topic that we're talking about, inflation. Around 2 weeks ago now, there was an inflation print, so a data point that's published every month. And this data point from the US demonstrated that inflation had not peaked. And there was an expectation that in the US, given that they are raising interest rates to try to tackle demand side inflation and thinking about the increased costs of goods and services that are slightly outside of the control of the demand side, so thinking food and energy, which have been impacted by the war in Ukraine, that is not so much of an issue in the US. They are net exporters of energy. They make a lot of their own food. So the major driver of inflation, the central bank in the US, the Federal Reserve, felt by raising interest rates, there'd be in a situation where they could get that inflation under control. The market was expecting that too. And so when the data was released a couple of weeks ago, demonstrating that inflation was not under control and had not peaked, that really sent the market into a tailspin. So that was the Friday. On the Monday, there was a journalist that leaked the a plan from the Federal Reserve to raise interest rates not by 50 basis points, 0.5%, effectively a double rate rise, but by 0.75%, 75-point rate rise, which is the first time in 30 years that has happened. And again, that sort of compounded concerns by the market that the interest rates weren't being as effective as the central bank had hoped, and even potentially thinking about will the US be in some sort of recession next year and beyond. So we moved from pricing the risk of inflation in markets to actually pricing in or starting to price in the risk of recession, which is a whole nother set of risks. We're not in recession in the UK yet. We're not in recession in the US. There's still a 50-50 chance of recession in the US, looking at what our think tanks are telling us. The Federal Reserve, the markets are saying it's a certainty. That I think is still the rhetoric. That is what they're trying to that's the view they're trying to generate. And there's a bit of it where if they say that we're going to be in recession, people start to unwind spending and button down the hatches, and then inflation tends to come down on its own. So I think a lot of this rhetoric that's put out is that the Federal Reserve really having a bark worse than their bite. But it does remain to be seen if the bite continues to be as aggressive as we've seen so far.
Okay, so it's really about making a fair amount of noise before possibly this actually happens to try and actually change behaviors within the various economies. I think it's fair to say that central banks are able to place themselves or countries into recession to try and really make sure behavior does change, because otherwise it's really, really difficult, isn't it, to make people change their viewpoints, especially when we've had such a prolonged period of growth, low inflation, low interest rates. This is coming as a real shock to a lot of people, that for the first time in a significant period of time, we may have to change behaviors. And I think that comes quite hard for a lot of people. Is it fair to say then that a lot of the volatility and the drops in the market that we've seen over the last 3 months is pricing in the fact that in possibly 3 to 6 months' time, the US could find themselves in some form of a recession, and the UK in some form of a recession? So what I'm saying there is it fair to say that the markets invariably give us an indication of where we might be because they're forward looking in 6 months' time?
Yeah, I think that some parts of the market maybe are demonstrating that we could be in recession. There is a higher chance of being in recession here in the UK than there is in the US. For those factors that I mentioned, there are more parts of the inflationary picture, if we think about the breakdown of inflation, that are more in control over in the US, and you see inflation in the US currently lower than the UK. I think that will be the state of play for the months to come. And there are reasons to suggest that the inflationary picture in the US can come under control much sooner than in the US. But if we think about what the markets are telling us, something that happened this week was actually looking at the bond market, and often the bond market is a forward indicator versus the equity market of what's going to happen. The bond market now looks to be pricing in the idea that interest rates will be falling in April next year. So what does that tell us? Well, actually, it tells us that the US may be in a recession, or the bond market is assuming that the US is going to be in a recession. And so they're going to have to cut rates in order to stimulate growth. So it will be an extremely short cycle, and the recession period will be, and this is what the bond market is saying, this is not necessarily a certainty. And again, this is a 50-50 chance according to our think tanks. So we don't want to direct the entire portfolio towards something that isn't necessarily going to happen. That's very important. But the bond market is certainly telling us that actually it might be interest rate cut season April next year. And therefore that tells us that the bond market thinks we'll be in a recession in the US.
Okay, and that's really because they want to try and stimulate growth at that point. They've obviously choked off effectively the growth towards the latter part of this year, and then they obviously need to get the economy going, but in a more measured way, and try to get some growth back into the economy. So actually, I take that as a positive indicator then, that we've obviously, all we've heard really over the last 6 months has pretty much been negativity, negativity, negativity. But actually, it looks to me like for the first time we could be seeing some green shoots. Should I, dare I say that, even though officially here in the UK, we might be starting to feel the pain over these next few months. This is where hopefully we can see some green shoots from next year onwards. And it's also probably fair to say that in most portfolios that are out there, the US is still the biggest economy that is driving growth across the globe. And it's fair to say, I know your portfolios, you have a fair amount of weighting in the US, less so in the UK, just because of the political situation and everything else that's gone on in the last 6 years here. So from your perspective, fairly buoyant and positive about 2023 based on those indicators?
Yeah, I think that the one thing that's difficult to sort of comprehend, I suppose, is the fact that if we say that we might be in a recession this time next year, let's say in the US, that does not mean portfolio and share prices are going to go down from now until that point. Mm-hmm. Markets are forward looking, and if anything, we are starting to see the recessionary risks priced in now. At which point, when we're in a recession, as we've just discussed, there'll be economic stimulation going on, and therefore companies may have a more buoyant future as a result of that, and being in a stimulating market environment. Fantastic. So yeah, I mean, I don't want to sit here and say the picture's entirely rosy, because there are still risks outstanding. We still have a war in Ukraine. We still have inflation. There's still unemployment. There's still employment issues. By that I mean the jobs market is extremely tight. It's very competitive for companies to try and hire people. And that, in an ideal world, softens. In an ideal world, the Great Resignation that we saw post-pandemic reverses to some extent, and there's more people in the labour market. But I think that will happen. I think that more tough economic environment for people will take a lot of those workers back into the job market, and that's a good thing.
Absolutely, because I guess just as a final point, really, just to run through, they keep talking a lot about something called stagflation. And my understanding of stagflation is that we can be in a vicious circle where we are self-perpetuating inflation. If there's not enough people there to work, we're all chasing a very smaller number of people there to employ. If that's the case, the demand for those individuals goes up. They can choose to ask for more money. In turn, that means that they can continue to have a lifestyle that means they want to go and buy things and do all the things they need to do. They're not pulling their horns in, they're not reducing their spending. And then because there's still that demand, that is just forcing up inflation further and further. So is that a fair assessment, and why actually interest rates rising at the moment is trying to break that cycle of stagflation? Because otherwise this could be something that just continues to self-perpetuate.
Yeah, absolutely. And I think that the other risk is this idea of deglobalization. It's been something that people have spoken about for a long time. So the Great Resignation is one way at which we've got reduced labour, but the other thing is if we are bringing our production onto domestic shores, then you don't have access to some of that really fantastic, very efficient labour. But it doesn't take long for companies to realize, actually, if supply chains are back and global travel is back, actually they'd much prefer to locate their labor in the place that's most economically efficient for them to do so. So we've been worrying about this globalization thing for many years now. I think it really started when Trump started campaigning back in 2015. And yes, there's murmurings of it. There's certainly conversations around it, making supply chains shorter and more sustainable and cleaner and safer. But actually, I think fundamentally the economics will shout the loudest. And I don't think deglobalization is a major risk to that picture.
Sure. Okay. I think the only probably exception to the rule on that, from my perspective, which plays into really your portfolios, is about energy independence. And I think that's really come to the fore. And certainly from the sustainable portfolios that you've got, they're well positioned from the conversation we had the other day to take advantage of that change in direction. And actually, you mentioned that Europe has ploughed a further 200 billion into environmental energy ways of supporting countries, and therefore you think actually the portfolios, such as sustainable portfolios, will be well positioned above possibly more traditional portfolios to take advantage of that. Is that again a fair assessment?
Yeah, I think in the years to come, we won't have that sort of cushy environment to invest in, where we can see growth and opportunity in every sector, in every country, in every geography. And it has never felt like that. But in hindsight, it sort of looks like there was opportunities, many opportunities. That doesn't mean that there won't be any opportunities at all, though. And I think that the war in Ukraine has acted as a further catalyst to the understanding by regions of the world, mostly Europe, of how important energy independence is. And one way of getting energy independence, really the only way of getting any energy independence, is to look to renewable energy, green hydrogen, in order to generate that. And that's why Europe's ploughed this, as you say, the 200 billion into Repower EU, their strategy to look to be able to make it much more possible, much quicker to get that renewable energy. But another area that we're seeing, I'm sure, opportunities in is food security. Another catalyst of the war in Ukraine is us being very aware of the interconnectedness of food supply chains, of the danger of having food being grown and being completely reliant on crops from certain countries or being transitioned through certain countries. And so we're seeing some exciting opportunities in regenerative agricultural practices, in precision farming, in ways to make crop yields higher over the short term and the longer term, whilst also reducing the cost of growing those crops. So, for example, using less fertilizer. So we're seeing some quite exciting innovation, and that's supported by government policy as well. You've seen the UK government come out with their food security strategy a couple of months ago. The same thing's happening in China, the same thing's happening in India. So supported by government is always a great place to start when you're thinking about investing, and investing in really good quality businesses that have been in that space for a long time. So yeah, there's definitely some bright spots out there.
Brilliant. And I think one thing you mentioned again the other day, you talked about vertical farming, something that I hadn't come across myself, and really plays into, I guess, the whole global warming side of things, about if you can grow things here in the UK rather than having to import them from other countries, but you can do it in controlled conditions. So would you mind just explaining a little bit about that opportunity? Because I think whilst we've talked a lot about what's gone on in the past, and obviously explaining why we're in the position we are now with the portfolios, I think it's really important to think about, well, how opportunities come out of left field from adversity, and why that type of company or area is of real interest to you guys.
Yeah, so vertical farms they sound like a futuristic concept. It's basically what looks like an Amazon distribution center, or probably shouldn't give Amazon any more credit than it needs. Any sort of distribution center, big factory from the outside, and from the inside you can grow fruit, vegetables in these little boxes, and it's completely temperature controlled and light controlled for each vegetable given their requirements. So it means you can grow lots of different vegetables in the same vertical farm. There are some enormous vertical farms being grown at the moment, being built at the moment. The largest one is being built in Gloucestershire. It represents 70 football pitches in terms of size.
Wow.
So thousands of tons of fruits and vegetables can be produced. The energy that's used to grow most of these vegetables and fruit is from renewable energy. So they have solar panels all over the ceiling of the farming site. You have no pesticides, no herbicides, the ability to grow vegetables that are free from chemicals in an environment that is perfect for that vegetable to grow. So the yields are faster and are higher. And the carbon miles are obviously extremely low, because often these distribution centers are right next to, the farming sites are right next to the distribution centers. So what does that look like in terms of volume? Well, 30% of all basil consumed here in the UK is now grown in a vertical farming site. So there are considerable effort. Well, there's considerable volume being produced and consumed in our market. So I think it's still quite new. It's still quite nascent. It's not possible really to get exposure to companies that are running vertical farming sites in the portfolios, but certainly we're looking for ways to get exposure to that whole theme. And whether it's companies that are producing the solar panels for the roofs, or the companies that are producing the robotics, because there's lots of robotics used in order to keep that temperature control and light control at the optimum temperature and light sensitivity. So there's a lot of different avenues, but it is certainly one solution to some of the biggest challenges we face around food security.
Fantastic, brilliant. Well, look, thank you very much for your time. It's a real pleasure to have you on our first ever webinar, Market Update. Hopefully we'll have you on again as time goes on, but that's a really good overview, and thanks ever so much.
Absolute pleasure. Thank you.
Cheers. Bye-bye.
Bye.